Now let's come back to earnings, because this market has gone up a lot, and principally in the hope that the earnings cycle will turn around very soon and we'll see a lot of momentum that we haven't seen uh, the likes of over the last 6 or 7 years in terms of earnings in India. Now, I was reading in one of your reports that one of your indicators, which is the leading earnings indicator, is actually predicting that over the next couple of years, earnings growth over a 2-year period compounded could actually be going up by 36%, or it could be going down 15%. So it's a plus 36 and minus 15, within which the range of earnings growth might oscillate. I mean, that's an unusually large range, minus 15 to plus 36. Could you talk a little bit about why there is such a large variance or dichotomy between the top and the bottom end, and which are the factors which could drive it towards each of these extremes? Because on that will hinge the final outcome for the market, right?
Yes, Udian, and the reason why there is such a wide variance is because we are, I think, in an inflection point with respect to earnings. There's a lot of policy work that has been done over the past 2 years. It started in September of 2019 with the cutting of corporate tax rates, and it marked the shift in government policy away from boosting the share of labor in GDP to boosting the share of profits in GDP. And if you just tolerate me for a couple of minutes, the story goes back to 2006, 2007, when Manrega was enacted. That was a seminal moment with respect to policy choice in India. At that time, corporate profits were booming. Corporate profit share in GDP had gone to around 7%. And Manrega was a moment when the government of the day chose to transfer some of those profits to the labor class. Now, in India, that unfortunately doesn't work very well to drive GDP growth because we have excess labor. And any move to artificially boost wages, it results in inflation, which is what we got eventually once the dust settled on the global financial crisis. And in fact, we went into what we would term as stagflation by 2013. Now, it's taken a long while for policymakers to recognize that may not have been the right policy. For India, actually, where supply constraints are nearly the order of the day, the better outcome comes from boosting corporate profits, therefore investments, therefore you create capacity, then you create jobs, you create wages, and you create consumption. And then you get a virtuous cycle of growth. It was something that happened between 03 and 07 as a consequence of some really tough reforms that were undertaken by the government between 99 and 2004. And I think we saw that shift in policy in September 2019. And it wasn't a one-off. It's been followed by several policies which are directed in the same spirit of boosting the share of profits in GDP. Despite COVID, the government did not relent. So we saw both fiscal as well as non-fiscal measures, so new labor laws, production-linked incentive schemes, more recently the revoking of the retro tax. We've seen the telecom package, the creation of bad bank. So a lot of things have happened over the past 24 months, which point to the government's commitment to boost the share of profits in GDP. If this commitment stays, then I think we are heading to the upper band. Something like 20, 22, 23% compounded annual growth rate in earnings over the next 3-4 years, I think could be the case. That takes the share of profits from 2% to say 4%. We still don't go back to the peak of 7, but we could still double in terms of share of profits. And if nominal GDP growth is say 10% and you just do a back of the envelope calculation, you get a compounded annual growth rate of 22, 23%. I think the market has got a little bit of a whiff of this. It's not oblivious to this. The market is damn smart. It gets this, and therefore share prices are trading faster or higher than what the earnings change has been in recent times. Eventually, of course, earnings will catch up. If they don't, in the event that either you get a reversal in policy or you get a event globally which causes global growth to slow down, then I think you go to the bear case scenario, and then earnings may not turn out to be the way my base case pictures it.